it's torn in half, memories in bits and pieces, traces of love long ago that didn't work out right, traces of love, ribbons from her hair, souvenirs of days together, the ring she used to wear, pages from an old love letter, traces of love long ago that didn't work out right, traces of love with me tonight. I close my eyes and say a prayer that in her heart she'll find a trace of love still there somewhere. Traces of hope in the night, but she'll come back and dry these traces of tears from my eyes. My mind is filled with thoughts of you. I think about the days of two. I search the room, but you're not there. Your perfume lingers everywhere, but it's only a memory of what our love was going to be. Only a memory, broken bits of you and me. Only a memory, only a memory.
Please take your seats. Our program will begin in 10 minutes.
World of pain, I have no fear. You fade away and disappear, and now I have to learn the game when no one wins or takes the blame. But it's only a memory of what our love was going to be. Only a memory now that we are history.
Please take your seats. The program will begin in 5 minutes.
That's what I said now. Princes, princess who adore you. Just go ahead now. One has diamonds in his pockets, and that's a friend now. This one who wants to buy you rockets, ain't in his head now. Marry him or marry me. I'm the one that like it, but can't you see? I ain't got no future or family tree, but I know what a prince and lover ought to be. I know what a prince and lover ought to be. Said if you want to come here, baby, just go ahead now. And if you like to tell me, maybe, just go ahead now. And if you wonder about me, flowers, just go ahead now. And if you like to talk for hours, just go ahead now. And if you want to call me, baby, just go ahead now. And if you like to tell me, maybe, just go ahead now. And if you like to buy me flowers, just go ahead now. And if you like to talk for hours, just go ahead now. If you want to call me, baby, just go ahead now. And if you'd like to tell me, maybe, just go ahead now. If you want to buy me flowers, just go ahead now. And if you'd like to talk for hours, just go ahead now. Oh, baby, just go ahead now. Just go ahead now. Oh, your Majesty, just go ahead now. Come on, forget the king and lion. Just go ahead now. Come on, come on, come on, let's go ahead now. Yeah, just go ahead now. If you want to buy me flowers, just go ahead now. Just killed a man, put a gun against his head, pulled my trigger, now he's dead. Mama, life had just begun, but now I've gone and thrown it all away. Sing it. Didn't mean to make you cry. If I'm not back again this time, tomorrow, carry on, carry on, 'cause nothing really matters. Too late, my time has come. Sent shivers down my spine, body's aching all the time. Goodbye, everybody.
Please take your seats. The program is about to begin.
Leave you all behind a bed for truth. I don't wanna lie. Sometimes wish I'd never been but alone.
Please take your seats. Our program will begin now.
It's been a summer of discontent for the global economy. Inflation is at a 40-year high in the United States and showing few signs of cooling. After initially calling it transitory, the Fed is now vowing to keep at its battle to bring down inflation.
At today's meeting, the committee raised the target range for the federal funds rate by 0.75 percentage point.
But the measures don't come without collateral damage.
Everyone thinks the Fed can handle this. That hurricane is right out there down the road coming our way.
With talk of recession looming, volatility continues to grip financial markets. Some say a hard landing now seems inevitable. So what phase of the downturn are we in? Where does one put money to work? We ask the biggest names across finance and economics how the current environment is impacting asset management, venture capital, crypto, private equity, real estate, and more. This is Bloomberg Invest.
Please welcome to the stage Bloomberg television anchor Alex Steele.
Hey everybody, this is exciting. I haven't been in front of people that were live for quite a while, so it's nice to see faces here. So a couple orders of business. First of all, welcome to Bloomberg Invest. Whether you're joining us virtually or different parts of the world or right here in person, welcome to New York. We are very glad to have you. So we're going to bring you the conversations from all the influential people from around the world and how they're investing their money and how they see the landscape playing out. In case you missed it, the CPI came in really hot this morning, which sets the stage for a really interesting day. You're looking at year-on-year 6.6% for CPI. Who said yeah? Because that's a lot. It's the highest since 1982. Let's talk about the market reaction really quickly. You got equities taking a dive. Yields are actually up. You're looking at the swaps market pricing in a terminal rate of near 5% for the Fed in March of 2023. You're also looking at 75 bips now for November. Potentially for December now is on the table. So there is a lot happening in the market right now, and that is a very confusing time. And that could very much lead to a totally different type of volatility and investing regime than we've seen. So it'll be fun to get their takes today. So before we get started, a couple announcements for everybody. I want to acknowledge our U.S. presenting sponsors, Crypto.com, Grayscale, Invest Triple Q, and our presenting sponsor, VinFast. All right, a little bit more. Let me get my pages here. There we go. Okay. For our virtual attendees, everyone, if you experience any issues with audio or video quality, don't ask me, but refresh your browser or use the chat box in the bottom right corner on your screen for some support, and some will be provided. Also, for today's event, we have partnered with Thyssen, an audio-to-text platform that is transcribing today's discussions in real time, making the event all the more accessible. And you can access Thyssen for the real-time transcription via the link in the corresponding sessions on the virtual platform. And if you were in the audience with us at Bloomberg today, you can find Wi-Fi information on your badge, so check that out. And whether you're in virtual or in person, we do want to hear from you. Makes it a much more interactive process. So take out your phones now. I know it's weird. Usually we say the opposite. And scan this QR code. We'll be doing live polling throughout the sessions. And you can also write questions in to our speakers, and we will try to get to them, of course. To access both of these features, you can scan the QR code on the screen or type meet.ps/Bloomberg Invest into your browser. So meet.ps/Bloomberg Invest in your browser. We'll also continue to flash it throughout the event as well. I'll give you a moment to get to that because there's a polling question coming. Scan that QR code, click the polling icon on the bottom right of the screen. You can toggle back between the Q&A as well as polling if you go to the bottom of that screen and click the icons. Yeah? Okay, let's get to the poll. So the first one is, it's kind of funny considering the CPI number, when do you think the Fed might start cutting rates? First half of 2023, That feels really optimistic at this point. Second half of 2023, first half 2024, second half of 2024, or never. Just kidding. That's not a thing. Cast your vote now. It takes about 40 seconds to get the results, and then we'll discuss them in a moment. And just to point out, we do want to hear from you, polling and questions, so please engage with us on social media. It truly does make these kind of events a lot better. Use hashtag Bloomberg Invest, and you can follow along today's coverage and event by following at Bloomberg Live on Twitter, LinkedIn, and Instagram. If you have a Bloomberg terminal, look for us on the function Live Go. Okay, let's see about the polls. Wow, that's interesting. And I guess that's how you make a market. If you have 30% second half of 2023, 30% first half 2024, 30% second half of 2024. And therein lies the volatility in the market, guys. So that's actually a really interesting response. So let's hear from some people who actually know a lot more about this than I do. Aries has about $334 billion in assets under management as of the second quarter. They are deploying money. Banks are pulling back from lending. There's worries about bank lending freezing, and guess who that creates opportunities for? People like Aries and the private credit world. So let's get to Michael Arougheti, co-founder and CEO of Aries. Coming up. Hi.
Hey.
Welcome.
Thank you.
So what did you think of that poll?
That's what I expected. Well, it was just so exciting.
Stand up.
I think it's to be expected. I think this is, as you said, the challenge of investing in these times is the data is hard to interpret. And I think depending on your lens, you're gonna interpret it differently.
So you have 30% sees back half of 2023, 30% front half of 2024, 30% back half of 2024. Is that more volatility and more market for Mike?
It clearly is volatility, and I know we'll hopefully talk about the alternative investment front. When I look at that, that calms me, because as an alternative investor with a 5 to 10-year horizon, if we're banding around a 6 to 9 month window where we'll get some stability, that's a great environment for me. So the beauty of what I do is I don't have to get caught up in the day-to-day headlines. So that's actually quite comforting.
You can read that?
Yes.
I'm so impressed.
I got LASIK about 10 years ago. It's still working.
Okay, fair enough. He's looking at the poll on the screen, by the way. So based on that, though, and I appreciate that this might be a 9-month window of, say, volatility, but it could herald a whole different regime, right? Higher rates for longer, terminal rate of 5%, increased volatility. Just look at the UK. And that does affect something that you're going to be investing in for 5 to 10 years.
It does. It affects flows. It affects the trajectory of cash flow. But when you put it over a 10-year horizon, and this is something that I keep trying to tell myself and the folks that work at Aries, we enjoyed incredibly high returns on the other side of this. And it's not so long ago that we were in an environment where we were managing 5% rates. So we're all grappling with rate of change and uncertainty, but when we settle in a world where we have a 4.5% to 5% terminal rate and the markets adjust to that, we know how to do that. So the day-to-day volatility, I think, presents opportunity for those that are willing to look through it, those with liquidity and those with a long-term horizon. But the opportunity that we're all looking forward to is something that we've all done before. So from my seat, this feels a lot more like a traditional credit cycle, and I think that's being reflected in the underlying performance of the economy. We're coming off of 2 big crises, one the pandemic, one the GFC, totally different. So I think the psychology is still a little, we've grown to expect that every time that the markets are going through a transition, it has to be chaotic and it has to be a major crisis. That's not the way I'm feeling about this current environment.
And that the Fed's going to eventually step in to solve everything.
I think the Fed is doing exactly what they told us they're going to do, right? So the markets may not like what they're doing in certain cases, or they may wish that they were doing something else, but the key to successful central bank intervention is to actually do what you say you're going to do. So I think the challenge that you have in the UK, for example, is a lack of credibility and a lack of clarity. The Fed is telling us exactly what they're going to do. They're doing it, and the markets are responding.
Mm-hmm. So let's get to all of that. There's so much to unpack, but let's just start with the opportunity in credit, for example. So if you're looking for a default cycle, does this create more or less opportunity for you? How do you make money off of that?
Sure. So in our credit business, the bulk of our credit assets are in the private credit markets. So we are self-originating and controlling assets, portfolio managing them in a way that's slightly different than if you were buying high-yield bonds or leveraged loans. What I can say is if you look at the portfolio performance, the underlying, and we have investments in close to 3,000 middle market companies, the underlying performance is still very strong. So I think what is making this so challenging is the inflation picture is a reflection of a still strong economy. Usually when we're talking about risk of recession and defaults, the economy is already weak. We're projecting weakening, but we're not seeing it yet, and that's actually quite challenging, particularly because spreads aren't necessarily reflecting the potential distress. So if you look at where default rates are now, they're still near historic lows. If you look at interest coverage rates across the sub-investment grade market, they're still at or near all-time highs. There's a lot of dry powder and liquidity in the market. The markets are functioning well, so we're not seeing a lot of structural imbalances. So it's an interesting time, right? Because you like what you own. The value of what you own has obviously come down given the move in rates, but you're not seeing massive credit deterioration the way that you would expect if people were so anxious about it.
Are we gonna?
I think you'll start to see it clearly. You know, that's inevitable. But again, when you look at the market's ability to navigate peak defaults, you know, through the GFC, we got up to 10% type default rates. If you look at historical averages, depending on the market, 3 to 4%, and we're sub 2. So we have a long way to go before we even get to a level of distress in these markets that just puts us on, you know, equal footing with where we've been before.
So a good example of how the markets are freezing up is Citrix and Brightspeed. When banks tried to offload those loans, they had a really hard time doing that. Did that process not work the way it should have? Or was there some disorderly stuff coming in?
It worked exactly as it was supposed to work. And I think the banks are clearly digesting a lot right now, combination of CECL, write-downs in their bond portfolio working their way through AOCI on their balance sheet, stress test constraining capital, and now unsold inventory. But if you juxtapose this to what we experienced in the financial crisis, no systemic risk really there. The markets are orderly, the loans repriced, and the market absorbed them. And candidly, those that were able to buy those assets from the banks at the prices they did, I think are going to be pretty happy with those exposures.
Did you?
We did, yeah.
Are you happy with that exposure?
I am.
So do you think, though, that the valuation hit that we've seen in the bond market and the equity market, public markets, does that eventually come to your world?
Yeah.
And I guess how bad does that look?
Well, so the private credit markets have been evolving over the last 20 to 30 years as the banks have grown, moved to scale, focused on investment grade borrowers more than sub-investment grade. So we have always lived in this world of symbiosis with the banks. When we get into a market like the one we're in now and the banks are effectively pulling out of the market, that means the loan market is effectively closed, the high yield market's effectively closed, the IPO market's effectively closed, the private markets, whether it's private credit or private equity, become a very important liquidity provider into the markets. And we're able to do it with a lot of selectivity and at some pretty attractive risk returns. So, you know, these types of markets tend to be very good investment opportunities for private managers.
And before we get to the opportunities for a second, I just want to get an idea of, do you feel like the banks are pulling back on lending in part because of all the regulations that they might have around it, or that they see something that you don't see?
I actually think that if and you'll have to ask bank executives, I think most bank executives would probably tell you what I see, which is credit portfolios are healthy, consumers stronger than you may expect, lots of liquidity in the system, and a desire to lend. I think there's some repression going on right now because they're dealing with losses from having to sell inventory. They're dealing with the implementation of CECL, as I mentioned. They're dealing with bond markdowns, and they're dealing with regulatory capital constraint. But banks are very well capitalized. The markets are functioning well, and their portfolios are strong. So I think if you got them in a moment of honesty, they would tell you that they'd like to be more active, but they can't be.
Let's get to where things are not functioning properly, and that is the UK. How do you look at the UK disaster meltdown? I'm completely editorializing, but who wouldn't say that?
How do you really feel?
I mean, come on.
How do I feel? I'll start with what I said earlier, which is I think that so much of this is about credibility and clarity, and what we're dealing with is a lack of credibility and a lack of clarity in central bank policy, and you have to start there. They're dealing with a set of issues that's different than what we're dealing here, UK and Europe at large. Obviously, the inflation that we're seeing here is demand-driven. We've got more fundamental economic strength. There you've got some supply-driven inflation and an energy overhang. I think the UK is interesting because it does speak to the interconnectedness of these markets and the known unknowns, if you will, of how some of these markets could bleed into one another. But again, it's functioning. So they intervened. They finally gave clarity, said we need to fix this as quickly as possible. We have a lot of UK pension clients. They are taking that very seriously. I think they are selling assets appropriately, and that will then resolve itself. So as disorderly as that feels, that even happened in a pretty orderly fashion in terms of the market's ability to absorb it.
If tomorrow we don't get the BOE buying anything and that deadline's real, what happens?
I think we go back to business as usual and we wait to see another card.
Okay, so like it'll be bad, but we can still manage, is what your point is. So are you buying in the UK right now?
We are selectively buying in the UK. We're active. Obviously, I would expect, given the state of the pound, that you'll start to see funds flowing into that market on a relative basis. We're active in the private credit market. We're modestly active in the alternative credit space. And we've been active, as I said earlier, as a liquidity provider to some of these asset owners that are looking for liquidity.
Would property be interesting to you? I read an article this morning that I think was like 20% is what we could see in a fall of UK property values.
Yeah, we have a very large European real estate business, and obviously when you get this type of a re-rating, there's going to be opportunity to invest.
So let's get regional for a second. I know I have a question for the audience, which I will get to. But let's go to our next poll. So the poll we were looking at is, where do you think the biggest opportunity, what do you think provides the best opportunity? We're talking about the UK. Let's do Asia, Europe, US, and UK. We'll take a couple seconds for you guys to pull in on that and which one you guys like the best. But if the UK is investable for you, is Europe?
Europe's absolutely investable. As a private manager,
everything's investable at the right price.
Everything's investable at the right price. I think that's exactly right. So our job is to be in local markets, understanding assets and companies, and then putting money to work. What's challenging is those days are over for now because it's all macro. But at the end of the day, we are very, very micro, local investors looking at discrete assets, discrete companies, discrete cash flows. So most private investors have to be macro aware because it affects flows and values, but you have to be great at the micro. Because the macro, again, over a 5 to 10 year period, you're going to get your window because you're never a forced buyer and you're never a forced seller.
So to that point, this is what you guys said. So we're looking at, I honestly can't see, 40% for Asia, 9% for Europe, US 42%, and UK for 7%. So I'm wondering, if you see that, are you like, yes, UK and Europe invest right now, US and Asia, maybe valuations are too hot? Is that, how would you read that poll?
I always have a challenge with questions like this because what asset class, what market, what return expectation, what volatility. So if you said Asia, in Asia right now, we're active lending in the developed markets of Australia and New Zealand. We're active in the bond markets, taking advantage of a fair amount of distress there. We're fairly active in the infrastructure lending space, all with completely different risk-return profiles. So yes, there's plenty to do in Asia, but it really depends on where you are. Same with the US. So from my perspective, all of these are investable. If this is a reflection of where can you generate the highest risk return, that's probably maybe what this is reflecting.
So let's go to alternative asset investing.
Yeah.
What do you like? What's interesting?
Right now, for markets like this, when they're transitioning, we are doing our best to stay shorter duration, lower risk, floating rate. So of our $335 billion, over $200 billion of it is in private credit generally, which is performing very well, obviously, given the increase in base rates, and now spreads widening is presenting a pretty good opportunity. So we're able, in the private credit markets, to generate 10 to 12% type rates of return to take senior risk. That's a pretty comfortable place to be right now while we wait to see the markets transition. When you start reaching for that 15 to 20, price discovery becomes an issue, and you're having to take on a healthy amount of risk to capture that excess return. So my own personal view is we're trying to stay, less risky, a little bit more cautious, and capture all of the excess return we can right now without putting ourselves too far out on the risk spectrum.
So to that point, if we look at where the leverage is and like the big ball of leverage that's been rolling around since the dot-com bubble, even before that, where is that right now? Some would say it's in the credit market, corporate credit, or alternative assets.
It's on central bank balance sheets. So
that's
where it is, and everybody is always trying to find where the canary in the coal mine is. That's where all the leverage went. And the interesting thing about these markets, the consumer is fundamentally deleveraged. The banks have deleveraged and simplified. The private credit markets have actually deleveraged. They've grown, but the attachment point in terms of where they are relative to the equity is lower than it's ever been. And they're supported by much larger, much more mature, much more evolved equity markets. So from a market setup stability standpoint, it doesn't feel like there's excess leverage. Again, I think we're all thinking back to the prior crisis and saying all crises involve some form of excess leverage or some part of the financial markets where there's bad behavior that we can't see. Based on what we see, we're not experiencing that right now.
So there's a question from the audience, which is a fun one. So if the recession and higher default rates don't come, and to be fair, I feel like I've been hearing about default rates since 2015, where will portfolio positioning be wrong-footed?
I think right now one of the challenges is the markets are not, because of the fundamental performance in certain markets, reflecting spreads commensurate with the amount of distress that people are expecting. So if you look at leveraged credit as an example, most of the attribution for the return we're getting now is just the increase in base rates with a modest amount of spread widening. There's probably more spread widening to happen, which makes it a more attractive opportunity, but then obviously will challenge the valuation of what you own. I think in the private equity and probably more so in the growth equity and venture markets, I'm not sure that those markets have readjusted yet to the new valuation environment. So I think those portfolios still have a way to go to reflect, the potential future economy here. But I think investing in credit through a cycle is a great place to be.
That was the next question. Do you think investing in credit is a good move in a time like this? I mean, he's going to say yes.
If not, I'm out of a job, so I have to believe it.
No, he's definitely retiring. But to that point, we were talking about alternative assets for a second, and I understand that you're on the cautious risk scale spectrum, if that's not a complete oxymoron. Is there a level, though, of rates or the Fed or neutral rate that freaks you guys out?
No. And again, we've been investing in these markets for 25, 30 years, and I just remind people, we've had 5% rates before. We've been through recessions. Investing with anxiety is not a successful investment formula. So I think we try to understand what's in front of us, invest based on what we know, and I do think that there's a lot that we see given the assets that we own around the globe. But the ability for us to pivot from liquid markets to illiquid markets, or debt to equity, or real assets to corporates, gives us a fair amount of confidence to navigate these types of markets. So no, there's not a level at which we get anxious. It just means that the mix of our deployment is going to change.
Okay, fair point. So alternative assets, then, if people are like, oh, that's too illiquid, that's a problem, the way Mike looks at it is, sure, but then I have all these other things to make it okay.
I think liquidity, and it's I don't know if this is the right way to express it, I think that people overvalue liquidity. And what has been happening over the last 20 years is people realize that when they get into difficult markets, all of the liquid assets that they own are fundamentally illiquid because they don't want to sell them at the price that the market is willing to bid them. And so...
So they're just mad that they're not getting what they want?
Well, then they're illiquid because you have all these people that are sitting on high-grade bond portfolios that are saying, I'm not going to sell this at this price. So by definition, if they're not illiquid, they're less liquid. And so most of the institutional and retail investors that we manage money for sequentially over years are reevaluating their actual need for liquidity and being more comfortable taking real illiquidity risk in their portfolio because they can still get some pretty significant excess return by taking on that illiquidity. And that's been happening sequentially with every crisis.
Is that a danger, though? Or what point does that become a danger?
I don't think so. I mean, it's interesting. I think one of the reasons why the market is functioning as well as it is now is as the private markets have grown and evolved, we're able to step in almost as a support mechanism for the liquid markets, right? So if you think about the leveraged loan and high yield markets sitting on the other side of the private credit market, 20 years ago, these markets would be showing significantly more volatility because you didn't have natural cash buyers on the other side of this distress. You had the banks that were in making markets with retail investors that was exhibiting a lot more volatility. Now you have some pretty large private managers that are actually able to step in and buy those assets and support prices in a way that they weren't before. So I actually think that private equity, private credit, they've all actually proved to be pretty significant stabilizers in these types of environments.
That makes perfect sense. And the other end of that, though, people would say, yes, but has that kind of capital and that kind of business model been tested in the same way in a massive crisis and a massive blow-up?
Well, COVID wasn't easy, and not only did it perform well, it performed exceedingly well. The GFC was not that straightforward, and we performed okay through that. .com, so each one is different, but I think we now have, 30 years of actuarial evidence that would tell us that the private markets are doing what investors expect them to do.
I'm going to sneak in one more question. What's the thing you're most excited about over the next year, investing-wise?
Oh, I thought I was about to say Yankees winning the World Series.
Or personally, it could go either way.
This is about as good of a time to be in our business. I don't mean everything's rosy and we're making money hand over fist, but it's finally interesting again. I mean, if you're a professional investor, for 15 years, everything was up and to the right, and everybody looked like they were, great at what they did. We have a whole generation of investors that have never been through a cycle. So we're finally we're getting a good old-fashioned cycle with a lot of cross currents and a lot of information. Everything's exciting right now, to be honest with you. This is about as interesting of a time as we've seen.
That's great. Great to end there. They're flashing us off the stage with red, sadly, but I can talk to you forever. Thanks, guys. You've been a great audience. Mike, I appreciate it. Thank you very much.
Thank you. Thanks, everybody.
Please welcome to the stage PGIM President and CEO David Hunt, Franklin Templeton President and CEO Jenny Johnson, and BNY Investment Management CEO Hanneke Smits with Bloomberg's Romaine Bostick.
Come on and dance with me. Clap your hands with me. Go to France with me. Come on and dance with me. Come on and dance with me. Clap your hands with me.
We were just joking backstage about basically having three of the most important people in asset management here on the stage with us today. And of course, today we're supposed to talk about the future of the asset management industry and really about the growth of that industry, where it's been and where it's going. But I'd kind of be remiss to have three people with this type of experience and this type of talent and not get your thoughts on some of the current market conditions, the market volatility, and maybe some of the structural changes that we've been seeing in interest rates and inflation and everything in between. How does that, what we're seeing now, if at all, change the complexion of what you do? Jenny, you drew the short straw.
Well, first of all, I think for active managers, volatility is a good thing, right? And so I think in these types of environments where you have market volatility, it's an opportunity. I think, the opportunity gets more difficult. And I think in our case, especially if you look at where CPI came in today, that, things like less risky assets, investment grade credit. I think, it's during these bear markets that you're reminded that 40% of return comes from the dividends. Good time to have good, solid cash flow, positive companies with good dividends. And it's time where you really have to pay attention to credit and the trends. Mm-hmm. So I think that's an opportunity for active managers.
Are you shifting strategies right now at all, Hanneke?
Well, we're seeing clients having interest in different kind of strategies, but I have to say I agree with Jenny. It is actually a very good time for active management. I'm always reminded in times like this of the line of Kipling's poem, and when everyone else around you loses their head, you kind of need to stay calm. It's very, very important. And you need to stay focused and be very deliberate where you invest. In this kind of environment with, where we just saw the CPI figures, you can't rely on growth as a factor to invest, but it doesn't mean that you cannot invest in companies that deliver growth. we have portfolios where companies are delivering growth at sort of double the rates that we're seeing in the indices, and that continues to be exciting. Income value investing, we're seeing that too. There's interest in that. When you can't invest in growth, it's good to see that dividends can contribute and make a meaningful contribution to returns. And in a risk-off environment, I think it's not far off for us to also see an interest in fixed income assets again as rates are on the rise.
Are fixed income assets attractive now? Or at least relative to what they were a couple of years ago?
Looking a little better for sure. It's always great in our industry to look at history and try to take lessons from it. But if you spend too much time doing that, you also spend your time fighting the last war. And what we're watching right now is the Fed fighting the wrong war, and we're watching our fiscal stimulus colleagues, whether it's in the UK or the US, fighting the last war. And what I mean by that is that after we came out of the GFC, I think most governments came to the realization that they had not done enough to stimulate their economy. And they vowed, never again, we are going to go all in on this. And so what you have seen around the world is that governments have basically put 10% of GNP back in to their economies, and another 5% that they've allowed to be borrowed. So you have an enormous stimulus that's coming from fiscal policy that you haven't seen in 20 years. At the same time, the Fed is fighting the war that they remember so well from the 70s. They are going to get inflation down. And I think they have a lot of focus on that. But, the world is not like the 70s. And that is a war that's not worth fighting again. We're not going up to 20%. So what we're looking at now is a different macro environment than we've had. We are going to look at an environment that has higher inflation. Those days of we can't get to 2% are over. We're going to look at a rate environment that is, I don't think high by historical standards, but is nevertheless higher than we've had since the GFC. And we're going to go back, unfortunately, I think, to a fairly low productivity, low growth economy. That is a very different environment to invest in than we've had. And to your point on fixed income, yes, fixed income and I would say all kinds of fixed, both public and private assets, are now in many ways a more attractive mix in that macro environment than they were before.
Still, everything you just said, that doesn't sound like a growth story to me. So where do you find the growth in that environment then?
It's not a growth story for the economy at all. Now, there's a big distinction between that and what we all see as growth in our businesses, which has actually been a really strong set of growth over the last 10 years. And I would really echo what you just heard Mike say from Aries. This is a great time to be a professional investor. The money that we put out now over the next 24 months, is going to be some of the best returns that we've been able to do. Our problem 3 years ago was everything was expensive. So I think that we're going to see real growth across a broad range of asset classes, and particularly in the private assets, which we can talk more about.
Sure. Jenny, I want to get your thoughts on that, particularly from the risk side of it. I mean, Franklin Templeton, similar to PGIM, similar to BNY Mellon, not exactly sort of the biggest risk takers, relatively speaking, out there in the financial world. But the structure of your business, the strategy that you've had over the years, is that resilient in the environment that David lays out?
Well, I mean, we've done 8 acquisitions in the last 2 years, and big focus on the private markets, because I think there are some structural changes that any asset manager, in order to deliver complex capabilities to clients, has to be able to be in the private market. So today, when we close our latest deal, will be about $260 billion in privates of our $1.4 trillion in assets. And I think the real trend is going to be taking those private markets to the retail investors. Wow. And because today you have half the number of investable public equity companies that you had in 2000. You have 5 times the number of private equity-backed companies. From a private credit, I think banks, because of regulations like Basel III and in the U.S. regulations, banks' capital, they're better capitalized, which is a good thing structurally coming into this environment. On the other hand, their capital's precious, so they're lending only to their best customers, and they're preserving their capital for that, and that's created an opportunity for the private credit markets. So, and if you look at the excess returns, and And the reality is there's a big difference between your top performing private equity, bottom performing. It's somewhere like 20% a year. In the real estate, private, the top performing versus bottom is like 10% a year. And private credit runs about 5%. So you have to select your managers well. But in that, bringing those excess returns responsibly, I think is a real opportunity. So we looked at that and said, all right, we have to be in this space.
An opportunity for excess return. Some would say there's also a lot of excess liquidity in that private market space as well.
There is. Are you looking at me?
Sure,
Yes.
why not?
So let me just first start about a little bit more about the environment that we're in. And what I just want to talk about is that notwithstanding the environment that we're in and heading into, I think some of the underlying trends that have impacted all of us here as asset managers have not really changed, right? You've had, and you mentioned some of them earlier, Romain, you've had the trend from institutional portfolios to the retail investor. We're seeing increased demand for customization. We're seeing also increased demand for low-cost delivery of investment solutions, but we're also seeing demand for differentiated investment capabilities, be it in the private markets, be it in specialty active investing. So we think it's really important that you build two things. First, those specialist capabilities, which we have at BNY Mellon Investment Management, but you also need to build scale so that you can deliver these solutions in a very cost-effective manner.
The best way to do that, is that through M&A?
You could do either. You could do M&A. You could also deliver it organically. We come from a history of M&A. This is how BNY Mellon Investment Management has been built up. We have consolidated the number of businesses and really focused the business around a number of centers of excellence, as we call them, with a number of key firms around the core asset classes, but for now we're very much focused on organic growth and delivering that through those firms.
David, do you need to be under that big umbrella? I mean, is there even room out there these days for, say, a private, standalone, sort of do-it-yourself type of manager?
So I think the thing to remember about private credit as we look at this, so we have about $250 billion in private assets overall, so we're one of the largest players at this. But is that these are not necessarily new asset classes, although they feel like it to institutional investors. But these were assets that 20 years ago were on bank balance sheets. Right. So who lent money into the middle market? It was the banks. Who did infrastructure lending? You had the commercial finance companies. Remember those? They did all the aircraft leasing. Those are largely now not growing or disappeared. And what you've seen is this institutional capital has come in. So the way the economy in the U.S., and increasingly I would argue in Europe, is being financed is coming through institutional asset management rather than through the banking industry. So it's not that these are new assets or that they didn't exist before. It's just how they're being financed is very different. So my answer to your question is that there isn't at the moment excess liquidity in that. Most of our companies are in actually pretty good shape. Leverage ratios look pretty good. You know, the actual defaults that we're seeing now in the leveraged loan market and others are very low. So I don't really worry about that, at least in the near term. There's plenty of room to run on private markets.
Jenny, you're nodding your head.
You know, I agree, and I was just thinking. I mean, if we actually look at your markets down, I don't know, whatever, 23, 24%, and you know, we've had a compression of multiples. We haven't yet had restatement of earnings. The consumer has, you talk to banks and their default rates are as low as they've ever been. You haven't really seen a bump in losses. Is that built into the market? You know, this expectation, if the Fed gets what they're trying to achieve, which is to slow down the economy and get inflation under control, we'll start to see some of those some of those structural challenges that happen when you have a slowdown. And we haven't seen it at all yet.
But systemic risk, is that something that worries you at all?
So I think to David's point, you know, it's just, first of all, most of the leverage has been pushed out onto the central bank balance sheets as opposed to we're really seeing companies and individuals healthier than they've ever been, you know, pre-COVID, and really you compare to the financial crisis, they're actually all in pretty good shape. So I think that's the good news that ends up being a bit of a cushion here. But with the action of the Fed, we have yet to see it really having an impact. And delinquencies and things are a little bit of a lagging indicator.
That's a U.S. story. Hanneke, I'm curious, does that apply to the rest of the world as well? Pretty much the developed world I'm talking about.
Well, I think in particular in the UK and Europe, some of those dynamics aren't all that different. Growth is hard to come by, but I would say certainly in the UK, which was also very leveraged before the financial crisis, corporate balance sheets have also reduced. The leverage on the part of consumers has come down as well, and that's been a good thing. But as Jenny and David have said, that has been absorbed in the UK's case by the Bank of England, right? Who did make a statement on the 22nd of September that they were going to start to unwind that program and start selling government bonds into the market, which decision they had to pause 5 days later because of what happened post the announcement of the budget in the UK. So the UK, I think at a high level, it also has high inflation, a low growth environment, a cost of living crisis. It's a difficult environment, but you can still find good investments in that environment.
When we talk about the growth of the industry, the growth of what you do, your business and how you run your businesses here, I mean, you obviously had phenomenal growth over the last 2 or 3 decades. There's been some challenges in recent years with obviously increased competition and obviously just a lot of the changes in market volatility here. When clients come to you today, new clients, prospective clients, what are they asking you for now that maybe was different than what a client 20 years ago would have come in the door and asked for?
So I would say clients increasingly ask for outcome-oriented investing, and an outcome can mean a bunch of different things, but they no longer come and say you need to beat the benchmark in this particular strategy by 200 basis points or 300 basis points. So they might look for income, they may look for inflation protection, they may look for tax efficiency. They may want to see some of their personal values expressed in their portfolios, and so it actually offers some very interesting opportunities for us, I think, also enhanced by the advancements that we've seen in technology, that we can actually better deliver customization to our clients. But those needs have really changed, and I think this environment will really accelerate that move from benchmark-based investing to outcome-oriented investing.
David, your thoughts?
So many of the very large, sophisticated institutional investors over the last 20 years have been very segmented in how they viewed individual strategies. And what they found is that they actually built up a bench of 200 external third-party managers who, when you put them all together, perfectly made the world's most expensive index fund. And what they are now doing is working very hard to dramatically reduce the number of managers that they work with. But then the demands on those managers to be global, to be highly risk management, to deliver the kind of outcomes that Hanneke was talking about, has gone up dramatically. And I would say that's one of the reasons that you're seeing a drive toward consolidation in the industry. It's less the kind of industrial logic of capacity and more that clients actually want to do more business with fewer players. Mm-hmm. And that started in the institutional business, but is now very clear in the retail world as well. And so you're going to see continually the large firms, I think, continue to gain share driven by that trend.
Are you seeing cost pressures, though, in your business from some of those changes?
Without a doubt. I mean, every time somebody asks for a strategic partnership, I watch my wallet, right? I mean, there's no... But that's good. That's competition. I welcome that. We should be under pressure on margins, and that's how we get better and we'll get more efficient. So I actually welcome that. I don't think that's a problem.
How about you, Jenny?
I agree with both. I think, I think in some ways the asset managers lost the plot with getting so focused on every little benchmark and slicing the investments to be able to measure every component. And in the end, clients are looking for outcomes, whether they're institutions or they're consumers or just investors. And I think the good news is that technology is enabling us to be much better at understanding risk factors, being able to deliver much greater customization to be aligned with those outcomes. I do think scale, for all the reasons David mentioned, is important. I also think any active managers are going to have to be exceptional at leveraging data and AI to gain insights, and data is really expensive. And so I think you need scale, and that will become a greater and greater part of how it feeds into investment processes.
How does that change who you hire, who you keep on board?
Well, I think we've all been talking about, you know, in your investment team, you'll see Python programmers and mathematicians, and you always saw some of that. But I think that, you know, it continues to be part of the whole ecosystem of an investment team. You're adding these additional types of capabilities.
Hanneke, with regards to the collaboration amongst some of those teams, I mean, you run a very sprawling organization, if I could use that word. How do you keep that together? And more importantly, what's the interaction there that sort of addresses some of the things that they just talked about?
So I would say actually we run a very focused business, but we do run it differently than some others because we have a multi-manager model, right? So what is distinct as part of this process that each of the investment firms is focused broadly on a distinct asset class, but also has its own investment team. And that is really important because that is ultimately what the clients engage with, right? It's the delivery of that performance and how that is delivered. What we deliver from the center, if you will, is support in data, in technology, in infrastructure, in distribution, and in particular in the retail market, delivering those strategies to the ultimate end client. And that's where the connectivity takes place. I agree with Jenny, the investment in data is very much required, but is also transforming each of our businesses. And I think it's transforming it in two ways. One, into the integration in the investment process. And I want to be very careful when I say that because the use of data and technology does not replace human judgment, at least in our view, but can very much augment it, right? Look, we're sitting here in the Bloomberg building. There's a lot of information out there that needs to get filtered and needs to get to the portfolio managers and research analysts in a filtered way. But I think the other piece where data and technology really plays an important role is empowering the client experience. And we're very much investing in that centrally so that the clients can interact better with reporting, can gain better insights, and know better what to do in changing environments.
How much do you depend on outsourcing, if at all, right now?
Not much, no.
Not much? Okay.
We do, well, it depends on how you define it. We run our own investment teams. We do outsource part of our operations to actually different providers, including colleagues in asset servicing in BNY Mellon. But we don't outsource the core of our business, which is really the manufacturing, because that is where the value add really takes place, nor do we outsource the management of the client experience.
How much of the client experience right now is still sort of wedded to, I guess, the traditional model, the one-on-one relationship with the advisor? Is there more of a demand, more of a request for, I guess, a DIY type of sort of relationship that maybe still includes the advisor, but also allows the client to maybe do something on his or her own?
So it's interesting, in our, we have a high net worth business, fiduciary trust, and you'll end up with very sophisticated investors who have made a lot of money. And by the way, once you've made a lot of money, you have a lot of opportunity cost to just spending all your time investing. And often you'll see some of them take a little piece of that and they play with that. That's sort of what they do. But they outsource the, you know, their real investment portfolio because they recognize it's not a part-time job to manage money. I think times like this are when people flee back to advice and are reminded why it's so important to have a financial advisor. So while you saw this proliferation of, you know, the individual going to direct, I actually think you'll start to see more and more coming back to the advisor.
Are you seeing that already, David?
We are, although I wouldn't so much call it kind of going back, as I think that there is a new sort of hybrid model of how people want to be serviced. And this is true both on the FA side, as retail side, as well as on the institutional side, where we see people do want direct access online to their portfolios. They want to be able to run models. They want to be able to run their own analytics. Many of our institutional investors want to do a lot of work through our portal. On the other hand, they really do value the personal, very customized advice that they get from our teams. They want to have those. They increasingly are happy to do regular portfolio reviews on Zoom. But when they have a real problem, like what's happening in the UK this week, they want to talk to us directly. There's no Zoom, so it's kind of in addition to, rather than going back to the old only in-person model. So you're seeing the combination of, I think, remote and the Zoom world, together with digital tools, together with direct in-person, all coming together. I mean, remarkably, and I don't know how you guys have found this, but over the pandemic, our share of mind with our clients actually went up. We were all worried that we're stuck in our pajamas, what's going to happen? And actually the opposite happened. We had more access. We had more intellectually interesting dialogues with them and more ways of getting to them. But I wouldn't have predicted that in the beginning.
Now, David, it's really interesting that you say this, because I assumed the role I'm in during COVID. And as I onboarded it, I was thinking, well, how am I going to meet clients and colleagues, right, over the summer of 2020? But I really believe that I've actually met more clients and colleagues over Zoom and connected very well with them than I actually would have met had I gone on the traditional world tour of meeting clients and colleagues physically. So I think we've learned a lot, and I think COVID has really turbocharged how the changes that we're making in how we engage with our clients, which combines both the digital experience that David just talked about as well as the in-person experience.
When we talk about growth in this industry, whether it's growth in assets under management or just generally growth in your own profits and stuff, where are the geographic opportunities? Is it still the United States, or are you sort of maybe have your eye on a different region of the world? Jenny?
I think U.S. is great, but I also think Asia. I mean, they're going to be, they say there'll be 1 billion people who enter the middle class, 87% in Asia, in the next decade. So I think, interestingly, if you look at the strength of the dollar right now, so one is it's kind of a sign of people want less risk, right? So it's your safety currency. The worst performing other three currencies are the euro, the pound, and the yen. Now so when you talk about safety, traditionally those were always viewed as safety currencies. But because of the structural issues you see there, you're actually seeing Asia and emerging market currencies holding up better. And I think that's also a sign that there's just great opportunity in Asia.
When you talk about economic shifts, economic opportunities around the world, obviously everyone looks at China and says, what's that economy going to be like a few years from now? How dominant can it be? And can it sort of usurp some of the dominance that the United States has had? Is there a story there to be told, David?
So I think there's a long-term story to be told there, but in the shorter term, I think it's a bit more complex. I mean, as we look around, and we really don't view our success about our own growth or our own profitability. We look at our duty is to our clients. So what I care about is excess returns to my client. But if I look out over the next decade, there's going to be a lot of excess returns that is built in Asia broadly. I actually don't like the categorization of emerging markets at all, because I don't really think that South Korea, China, and Argentina have anything to do with each other. And so increasingly we are building very much more bespoke portfolios, in particular around China. China's a really interesting case. So it used to be that you could get your exposure to China by owning Apple, right? Because so much of their sales. As that declines and as the linkages between countries decline, actually the importance of getting your alpha in China has actually gone up. And that's why even as you see, tensions geopolitically rise, you're also still seeing financial firms being willing to invest in trying to make sure that they understand the online and on-the-ground capability of what's happening in China.
Hanneke, your thoughts on that, please?
I think there's two aspects to this question, right, that you just asked. There's what does it mean from the perspective of investment opportunities for our clients, and I do think there will be interesting opportunities going forward in China, but you've got to be investing in the long term. I think the other aspect of it is what does it mean for our businesses, which is what I think you were asking earlier. And today, the U.S. retail market is still the largest market in the world, still growing, so it's very, very critical, I think, to all of us. But next will be China. So you got to make sure that you can compete in both, that you can be effective here, but also start to focus on what might be around the corner. But then we're really talking about a 5 to 10 year horizon.
We only got about a minute left here. I do want to just kind of go back in time. I mean, all three of you have just a wealth of experience, decades of experience in this industry. And I'm wondering if there are any sort of mistakes that you've made with the benefit of hindsight now and all the knowledge you had. You go back to when you were a fresh-faced 20-something-year-old. Here, is there anything you would have done differently? And Jenny, I'll start with you, because you're blushing more than everyone else.
Let the youngest start.
I've had plenty of mistakes. Look, I think the way I'm going to answer this is, Franklin's been around. This is our 75th year. You only make it 75 years because you evolve with the clients in the industry. And I think we are in one of those inflection points where there's tremendous technological innovation going on. I think there's obviously all the geopolitical risks, and we have to evolve with that. And my big fear is just that, missing some big trend.
Hanneke?
So I would say you need to stick with the strength, with the courage of your convictions. And when you, certainly as an investor, and I'm speaking as someone who has been an investor in previous roles, if you move away from that is actually when you get yourself in trouble. So you need courage, and you need courage of your convictions, and I think you need to follow through on those beliefs.
David, you get the last word.
So it's very easy, I think, in our world today, particularly, to overreact to the day's events. We get so much. Everybody in this room can actually tell me a lot about the CPI print this morning, and there'll be a whole lot of media that comes from all of that. And it's really hard, I think, to remember that we're in a long-term game, and we invest for decades. We've actually been investing for 140 years through presidential cycles and through economic cycles, and keeping that perspective, in which case many times the best thing is to do nothing, which is actually one of the most difficult things for all humans to do, and particularly for 25-year-olds. So I think that for those people who haven't been through a cycle, keeping that long-term perspective is the most important attribute.
All right. Oh, really appreciate all three of you being here. Please give a big round of applause for David, Jenny, and Hanneke. Thank you to all three of you. Thank you.
Please welcome to the stage Invesco QQQ equity product strategist Paul Schroeder with Bloomberg's Michael Arougheti.
Thank you. My name is Michael Arougheti. I'm an FX and crypto market specialist here at Bloomberg. Happy to be joined today by Paul Schroeder, who is Invesco's QQQ equity product strategist for Invesco's Q sponsor Spotlight Innovation as Opportunity. Welcome, Paul.
Hello, Mike.
Before we get started, correct me. I always call it the Qs. Some people call Invesco QQQ. What's the proper?
Sure. So, the proper name is Invesco QQQ, but obviously it goes by the Qs in many different situations, so feel free to use either.
And I love the title. We see markets moving up and down constantly, but it seems like over decades, innovation has constantly moved in one direction. But before we get started, can you give us some background on what the Qs actually are?
Sure. So the Qs are a passively managed ETF. It's become one of the most widely recognized tickers in the world. At this time, the Qs are the 5th largest ETF in the world, along with being the 2nd most traded ETF in the world. And it really has become one of the preeminent large cap growth ETFs out there. It accounts for 27% of all large cap growth ETF assets currently. Now, as I mentioned, it tracks the NASDAQ 100 index, which really it's invested in the 100 largest non-financial companies that are listed on the NASDAQ stock exchange. So what we've seen throughout the years is that NASDAQ has done a phenomenal job of attracting new companies and technologically focused companies really to list on their exchange.
Getting back to the title a little bit here, innovation as an opportunity. Do you think innovation relates to growth?
I definitely think it does. I think innovation is very tied to growth. I think a lot of investors also expect their growth companies that they invest in to be innovative. If you think about innovation in a different way, I think the ability to be innovative is also to be nimble. The Qs have a long-standing history of investing in companies that have been able to change and adapt as the markets have changed. A great example would be Amazon. Amazon started off as an online retail bookmaker, really to put Barnes and Nobles out of business. We then saw them become one of the largest online retailers, and now they're a massive web service provider.
So how would you quantify and qualify innovation? How do you define that?
Yeah, I think that's been one of the challenging things that we've seen throughout the past few years. We've obviously seen more and more investors looking for innovative companies, but you go to a company's financial statements, the term innovation doesn't show up. So the question is, how do you really quantify it? And we feel it really comes down to two different things. First and foremost, it would be research and development. That's something that does show up as an expense. And what we've seen from QQQ companies is that they've consistently spent more and more on research and development than the broader market represented by the S&P 500 and other growth benchmarks. We also see QQQ companies spend more on research and development as a percentage of revenue that they bring in, somewhere around 10% of all revenue that's brought in, which is obviously not a small number when you think of total sales that a company brings in. So we feel that research and development is the first thing to look at. A second thing would be our patents. Obviously, research and development is a long-term spend. It's something that isn't going to add to the bottom line necessarily this quarter or next quarter. It's an investment in the company to be relevant years down the line. But in the short term between that, you'd like to see these companies filing patents that hopefully will be supporting and helping out valuations over the short term.
Oh, that's fantastic. Paul, this was a quick commercial here, so I just wanted to say thank you for joining me today, and thank you, Invesco, for sponsoring and your spotlight for innovation and opportunity. Thank you very much.
Thank you very much, Mike.
Please welcome to the stage Bloomberg Intelligence Chief Equity Strategist, Gina Martin Adams.
Good morning. Thank you for joining me. I'm not sure about an introduction of high hopes for the equity market this year, but I'll take it. I'll take it. As mentioned, I'm Gina Martin Adams. I'm the Chief Equity Strategist for Bloomberg Intelligence. I'm also the Head of Portfolio Strategy and Equity Strategy for that team. For those of you who are not familiar, Bloomberg Intelligence is the research division within Bloomberg. I'm here today to talk to you about investing in a new inflation regime. Unless you've been hiding under a rock, you're quite aware that inflation has broken out to several decade highs so far this year. We got the CPI report again this morning. I'm sure you were all captivated by much more important and interesting content here at the conference, but CPI once again on a core basis is touching 40-year highs. We've gotten very little inflation reprieve despite the fact that the Fed is doing everything in their power to catch up to this inflation environment and contain it. But I do think that there are some secular concerns to consider, and they will have complications for your portfolio. In terms of the Fed, most people think that the reason we're in this environment of accelerated inflation is because of the Fed's extraordinary monetary policy accommodation, as well as the fiscal policy in support that we've experienced through the pandemic era. And certainly the Taylor rule does suggest that the Fed is well behind the curve and catching up. I do think that the Fed and the fiscal bodies will do everything in their power to start to try to restrain inflationary conditions over the course of the next 2 years. But it does I do have some serious questions about the long-term outlook. And those questions are really framed by my views on where the secular drivers of inflation, sort of behind the scenes of what we've seen during the pandemic, are some pretty big drivers of longer-term inflation pressures that I think are worth acknowledging. First is deglobalization. I call these secular drivers the 3Ds, deglobalization being one of those 3Ds. This chart shows you import restrictions over the course of the last 2 decades. As you can see, back in 2009, there were only about 70 import restrictions in place. By last year, that number had grown to 1,500. Discriminatory trade measures are now outpacing liberalizing trade measures across the world 4-to-1. Trade as a share of GDP peaked all the way back in 2008 and has only decelerated ever since. So as we've seen global tensions rise, we've seen policymakers respond. The result is tighter trade conditions, less geopolitical sort of cooperation, and much more constrained supply. Certainly a deeper embedded cost in the system than I think is often popularly recognized could create greater secular pressures on inflation. You add to that supply chain constraints that have come about as a result of the pandemic, and certainly weather risks that have been rising over the course of the last couple of decades, and you get a situation where deglobalization is truly driving some fairly significant change and embedding a higher degree of cost in the system than we've become accustomed to. Secondly, we've got decarbonization. This particular graph shows the supply side of decarbonization, but on the demand side, we see as higher weather risks contribute to higher inflation volatility, policymakers and corporates around the world really pursue a much more aggressive transformation agenda to new energy sources. The energy transition in itself has created a 5-fold increase in global green bond issuance over the last 5 years, evidence that we will see strong demand for infrastructure investment emerge to support this transition. On the supply side, we've seen this very anomalous gap result. The last time that oil prices accelerated this much over an 18-month period, you can see in the exhibit, production responded with a near 100% gain in rig count. We've not seen that this time around. The gap is resulting in tremendous supply constraints of traditional energy product as we work to develop new energy product, creating some embedded inflation in the system. And then third, this is a very simplistic graph of demographics. As you can see, generally, we're seeing the aging population reduce the available labor force. This is the share of workers aged 25 to 64, divided by the share of workers aged 65 plus in the United States, anticipated to decline pretty precipitously. By 2030, we will have 2.4 workers for every retiree in the United States alone. But this is really only half of the story. Globally, labor force participation has been declining for 20 years, including in emerging markets. So what do you do when you have an environment in which inflation is likely to remain somewhat higher, even after some cyclical reprieve brought on by policymaker reversals? Inflation in this kind of environment may remain somewhat higher than it has in the past. If that's the case, rates are likely to catch up with inflation. So there are 2 strategies for dealing with inflation in your portfolio. The first is find shorter duration stocks. This chart shows you our duration factor, the long-short duration factor priced against or plotted against the global ag, Bloomberg Global Ag Index. And as you can see, long-duration stocks tend to perform best when interest rates are falling. Short-duration stocks tend to perform best when interest rates are rising. If interest rates in general are set for a period of several years of general rise, we're going to see shorter duration stocks perform better. The second factor to consider is value. The value factor does tend to perform best in inflation. It's been a long time since value generally outperformed growth. Over the last 20 years, growth pretty much pummeled value as inflation was persistently decelerating. In an environment where inflation is accelerating, as we've seen this year, value stocks perform tremendously better than growth stocks. Last but not least, please visit us more. This is my page on the terminal, BI_STOXGO. You can receive any information you would like with respect to the equity market. We welcome your questions and comments, and enjoy the rest of the conference. I believe that I am the last person speaking before your break, so feel free to take a little break. Join us again at 10:45, have some coffee, network, take a bathroom break, and we'll see you back here at 10:45. So thank you.
Got a second to look at the dark side of the man. You love the thunder, you love the rain. You know your hunger, like you know your name. I know you wonder how you ever came to be a woman in love with a man in search of the draw the shade, light the fire for the night that holds you and calls your name. And just like your lover knows your desire and the crazy longing that time will never tame. You love the thunder, you love the rain. You know your hunger, like you know your name. I got your number, if it's still the same. And you can dream, but you can never go back the way you came. You love the thunder, you love the rain. You know your hunger, you know your name. You love the thunder, you love the rain. I got your number, babe, I'm leaving. I must be on my way. The time is drawing near. My train is going. I see it in your eyes. The love, the need, your tears. But I'll be lonely without you. And I'll need your love to see me through. So please believe me, my heart is in your hand. And I'll be once again. You somehow try to smile. I know the feeling we're trying to forget, if only for a while. 'Cause I'll be lonely without you, and I'll need your love to see me through. So please believe me, my heart is in your hands, 'cause I'll be missing you. Babe, I love you. Babe, say the hill's too steep to climb. You say you'd like to see me try. Climbing. You pick the place and I'll choose the time. And I'll climb the hill in my own way. Just wait a while for the right day. And as I rise above the tree line and the clouds, I look down, hear the sound of the things you said today. Fearlessly the idiot faced the crowd, smiling. Merciless the magistrate turns round, frowning. And who's the fool who wears the crown? Low down in your own way.
Please take your seats. Our program will begin in 10 minutes.
Every day is the right day. And as you rise above the fear lines in his brow, you look down, hear the sound of the faces in the crowd. cha-cha-cha, oh my. Let's spend the night together. Now I need you more than ever. Let's spend the night together now. Ba-ba-da-da-ba-ba-ba, oh my. Ba-ba-da-da-ba-ba-ba-da. I feel so strong that I can't disguise, oh my. Let's spend the night together. But I just can't apologize, oh no. Let's spend the night together. Don't hang me up and let me down. Don't let me down. We could have fun just going around and round and round and oh my God. Let's spend the night together. Now I need you more than ever. Let's spend the night together. Let's spend the night together. Now I need you more than ever.
Please take your seats. The program will begin in 5 minutes.
When the lights go down in the city and the sun shines on the bay, I wanna be there, yeah, in my city. Oh, 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 oh. So you think you're lonely? Well, my friend, I'm lonely too. I wanna get back to my city by the bay. It's sad. There's been mornings out on the road without you, without your time.
Please take your seats. The program is about to begin.
When the lights go down in the city and the sun shines on the bay, I wanna be there, yeah, in my city.
Please take your seats. The program is about to begin. Please welcome to the stage Blackstone's co-head of real estate, Kathleen McCarthy, with Bloomberg radio and television anchor, Carol Masser.
Oh my gosh. Good morning, everyone. Hi, Kathleen.
Hi. Love the music. That was great.
A lot going on. And I was just looking at some of the headlines from today. Core inflation rising to a 40-year high. Manhattan luxury apartment rents still hitting record highs. China's bursting housing bubble will rock the economy for years. Hong Kong property stocks jump on a potential tax cut report. It's a yin and yang of headlines on a daily basis, on an hourly basis. You guys, nearly $600 billion in your portfolio. Massive. World's largest. How do you see the real estate environment? Let's start macro, big.
So really macro, it is an exciting and interesting time because as you can see, there's different signals coming through, and I think we are better positioned than anyone to know what's really happening. We have $600 billion of real estate. We're in 37 different countries. A portfolio, though, that's highly concentrated into 4 key themes. 80% of our capital is in warehouses, rental housing, lab office, and hospitality investments. And what I'd say we're seeing is actually very strong fundamentals in those sectors. So when you talk about property performance, particularly for rental housing, that continues to be strong, partly because of the pressures on the for sale market with rising interest rates. Logistics demand, so warehouses. In the U.S. today, we are at record low vacancies, less than 3% vacancies in the markets we operate in, which are the densest, most urban kind of areas. And we're also seeing very strong rent growth. So in the U.S., and last month, rent growth in our markets was 30%. Wow. In Canada, it was even stronger, 50%. And so I think when we're thinking about the real estate market, we continue to see a lot of strength, notwithstanding there are pressures around us in terms of interest rates, an economy that the central governments are, of course, trying to cool, and persistent inflation. But we feel really well positioned for that. And I'd also highlight that I think this moment in real estate, this cycle is quite different than others we've been in the past.
Different good, different bad.
I'd say good, different. I mean, good, different. When you think about what kind of led to real estate downturns in the past, there were really 2 primary factors. It was too much capital, generally in the form of debt, creating greater leverage, fueling new speculative development. And it was too many cranes, too much development. And really, when you think about what happened in the years following the financial crisis, and leading up into COVID, we really never saw those excesses come into our market. And so as we head into a period where there may be more economic headwinds, real estate actually is really well positioned from a fundamental standpoint.
Economic headwinds or recession?
It's very hard to call, and I'm not.
Why is it so hard?
I think part of it is what we're seeing, and some of the things that I think the central governments are trying to combat, which is just this continued strength. They see low unemployment, strong rent growth. And that is part of what the big challenge is ahead. So I don't know if we're going to have a recession. I'm not an economist, but I would say there's definitely economic cooling.
Are you guys having conversations internally, like thinking like, hey guys, we need to be thinking that maybe in this market,
Yeah, what I would say is we've been planning for a long time, and this comes through in the portfolio we've constructed for an environment that might have been like this in terms of higher interest rates, higher inflation.
And so we really focused on trying to be in those high cash flow growth assets. And again, I'd say today we're still seeing those stronger than inflationary cash flows in our portfolio. But certainly, we are always trying to position for environments that change. We've been doing this for 30 years. We've seen a lot of different environments. We thought we had seen it all. And then COVID hit, and hotel revenues went to zero. I'm telling you, no one underwrote that before we had a pandemic. But the great news is our portfolios are built really to try to withstand any kind of environment. And the higher than anticipated rent growth we've experienced, again, may kind of come down modestly, but we feel really well positioned for that.
And distress for you guys can be opportunity, big time. We saw that after the financial crisis in terms of housing.
I would say environments with distress, with volatility, with a pullback in capital markets activity, and we're seeing in particular much more constrained capital markets today, that tends to be a great environment for us and really for any investor who is well capitalized and who has real strengths to lean on. So we have a data advantage. Our portfolio gives us more information on what's really happening. That helps us build conviction around what we want to do next. And then I'd say the combination of deep experience from a large team and capital makes us well positioned to really support situations where others may be needing to sell assets, others might need liquidity, and we're able to then get in and buy high quality real estate.
I want to ask you, this week on Bloomberg, Greenwich Economic Forum, Sam Zell commenting, retail is still very much a falling knife, and that the office market will see a lot of downward repricing. And then you had Barry Sternlicht at the Robinhood Investors Conference, of Starwood, of course, Capital Investors, says he sees incredible opportunities to find distressed investments in the real estate market. First, retail, falling knife, do you agree?
I think retail has been under pressure for a long time, and that's a big part of why we have not bought a shopping mall in the U.S. In over a decade. There are pockets that are showing greater strength, so grocery-anchored shopping centers in dense urban areas, but I'd say overall it's one of the asset classes kind of more under pressure. And in our business, we played the counterpoint of that, which was warehouse investing. So retail, brick and mortar, the movement of goods online is really what started that challenge. It was against a backdrop of oversupply in a lot of places. And so but there's always kind of other opportunities. And for us, it was, okay, how do we invest in the warehouses that are benefiting from the retail activity moving to a different format? But I'd say, continuing to see pressure in an area where we are more cautious.
But like India, retail's a different story. Because you guys are global.
We
have
are
to
global.
remember that. Yeah.
And I'd say there's overall been great consistency in the themes where we invest in globally. I think a market like India is a differentiated story, though. So in India, we're now one of the largest owners of shopping malls in the country. But there are, I'd say overall, relative to a population that has 1.4 billion people, there are very few of them. And so it's a very different story. It's a country where the growing middle class, greater consumption, people looking more toward organized retail as a place. They want to go not only to shop, but eat out and have experiences. And again, not so dissimilar to what are the formats of retail that are going to thrive anywhere in the world. It's something offering more than just a place to go buy something. It's got to offer that kind of experience, community, and a whole variety of things that will attract people to those stores. So our investment in India has been very successful. We made it, I think, at a great time also where there was a lot of change happening in the retail sector. More international retailers were able to access that market, and that really led to a lot of strong leasing velocity for the assets we were in. So a little bit different. And that's one of the great things that's so fun about our business is we have teams all over the globe. And while certainly there are asset classes like retail where we have a more cautious posture, we have the opportunity to dig in and understand what's happening, regardless of whether we know at the time it's going to be kind of an area to really dig into and do more. Right. That was an example where the team kept at it, kept thinking about standing the problem and the challenge and the opportunity on its head and said, this is a very different market. And I feel really proud that we have an investment committee that keeps an open mind to that and says, we kind of look we know where we kind of want to go, but where the other opportunities present themselves and we can invest in scale, we're going to activate that.
All right, so let me follow up on office market that Sam Zell said a lot of downward pricing to come. Do you agree? I mean, this is, I think, one of the grand big questions of our time. Yeah. Coming off of the pandemic, there's this constant flow of news stories about people not coming back to the offices, working from home, old office space people don't want. What's the reality from your perspective?
I'd say we see a lot of what you're describing, which is that And by the way, I would take a step back and say, if you go back pre-pandemic, I think a lot of the questions, the experimentation you're seeing with formats was starting to happen then. And so if we were together in 2017, 2018, I might have asked you, in your office buildings, do you sometimes feel like the lobby looks more like a hotel now, right? I see you're all chuckling, right? Everyone was kind of moving toward having more amenities, having better conference space, co-locating different types of tenants who could be symbiotic with one another. And I think even then, we saw tenants doing what they're doing now, which is saying, I'm not just looking for 4 walls to put my people in.
Right.
I am looking to create an experience. And we see that kind of thinking just much more pronounced today. Businesses, business leaders are saying, we do want our people back. I have yet to meet a CEO who is happy with everybody kind of staying in place on their couches, particularly now that there's more distractions than there were in May 2020. People want to be back. They want to propel their business. They want to propel creative processes. At our firm, we are really very much an apprenticeship culture. We need to train people. I need to be trained. I'm getting that all the time, too. And so what we see happening is those businesses are saying, what are the spaces that are going to attract people back and compete well with homes? And so the buildings that are newer, they have better amenities, they have better sustainability features, I would say also, those are attracting the best tenants. And then on the capital market side, you see that reflected as well.
Right.
Better debt costs for those kinds of buildings, better bidding.
WeWork, the idea actually makes sense in today's environment?
I would say WeWork as a offering for a tenant was a great idea and remains a great idea. And you see this replicated, imitation is a form of flattery, by so many office landlords and different office companies offering a version of that. Essentially, the way I think about it is, for decades, maybe eons, offices offered their customers, their tenants, one thing, which was a long-term lease in space that the tenant was responsible for fitting out themselves. What WeWork said was, we know you don't really know how to build out the space, but you want a place that feels good to come to. We also know you don't know exactly what you need 10 years from now, maybe even 5 years from now.
Right.
And so we're going to offer you a more flexible product that's really a customer service-oriented business. And that's a good model, right? And so that, I think, that concept is what we're seeing today. I'd say also what we're seeing in to your point, in the buildings that are winning in terms of both tenant demand and then capital markets activity, it's some of the similar things we saw a lot of tech companies gravitating to 10, 15 years ago. They had a population that was very mobile, that wanted flexibility. They wanted their places to be great places for those people to come to work. And you see a lot of those kinds of features showing up in the buildings that are the best ones today. We certainly, while we have caution on those older assets, and New York City is full of them.
Caution, or do you think at some point, like, their time has passed?
Well, it's a good question. In New York City, for example, it's a very old office stock market. The average building in New York is 67 years old. Only about, I think, something like 7% of the office stock is under 10 years old. So some of those buildings will have to live through a certain kind of transition. But in our, if you look at our activity over the past year or so here in New York, we bought into One Manhattan West, brand new, well amenitized, great location building. In Dublin, we did something similar, very similar recently. Best in class building, best sustainability standards, highly occupied tech tenants in a really dynamic part of the market. And so we will lean into those kinds of opportunities. But you're right, I think some of the buildings that are more challenged from the combination of age and features, maybe location as well, they're having a tougher time in this environment.
I want to ask all of you, first of all, who's got kind of flexible working, home and in the office? Okay, and who's just in the office?
2 hands up.
Who's just home? Okay, good feel. So a lot of flexibility. All right, I have another question for everybody. Our poll for our audience, and I think maybe some people have already been answering it. What area of commercial real estate is most attractive? And we put out hospitality, office, residential, retail, warehousing, all sectors that you guys, there are some of your major themes, and I think some of you have already...
Warehousing is winning.
Warehousing. All right, so what would you say is most attractive?
I think you're all smart investors.
Seriously? Warehousing?
We have been, warehousing has been our most significant investment theme really since the global financial crisis. Roughly 40% of our portfolio today is in warehouses globally. We have 1.1 billion square feet.
What are the returns on something like that?
So we invest in it across our strategies. So we have opportunistic, higher returns in vehicles that invest drive cash flow performance over a short period of time, invest and then return capital. And then we also invested in more stable strategies. We're trying to hold these for the long term. I'd say the tie that binds is the kinds of assets we're looking for and which markets. Our primary focus is really on what are known as last mile. They're not all technically in the last mile, might be last 20 kilometers, but think about those warehouses that can get you goods in the same day that are located close to dense population centers. So warehouse as a sector has done well, has been an outperformer overall, but we're always trying to be in the locations and the assets that have the best performance within a well-performing sector. And so that's been our focus. As I mentioned, we continue to see record levels of rent growth and record demand. It does help that we're in assets where we are attractive to so many different kinds of tenants who are doing a combination of things. The demand's definitely propelled by e-commerce, and we see e-commerce penetration rates continuing to climb higher.
Is there going to be even more that I think about as there's more companies we talk about coming to manufacture back in their kind of domestic homelands, that they're going to need these kind of facilities?
Absolutely, and we're seeing that happening, that the reshoring or just realignment of supply chains even within a country to be closer in to where those goods and the services ultimately need to be provided. I'd also say in a tougher economy where we're starting to see inventories build for retailers, those inventories go somewhere. It goes to a warehouse.
I want to ask you, we've got a great question from the audience. I'll bring it up in a second, but you sound very optimistic. Are you? What's a word? Like, I think about residential or even office. I think residential, we're like, is it a bubble bursting? Is it, hot? Like, what's a word to describe something like residential right now?
So residential, I'd say, is bifurcated. I think if you are in the business of selling homes, it's a more challenging market. And that is because the cost of owning has gone up dramatically in the last year. So we think in this country about 54% higher to own today than it was a year ago. Yesterday I was in Las Vegas. And what we're seeing is wide dispersion in the cost to rent versus the cost to own, with ownership being more expensive. In Las Vegas, it's 2 times more expensive to own a home on a monthly cost basis than it is to rent. But that is propelling the performance of rental apartments. So when you say you seem optimistic, it all depends on, I think, what you own and the sectors where you want to be more active. And again, we have a portfolio, and I see a fun question coming up now. You decide whether you want to take it about our portfolio today versus dark days of COVID. But I would say our
question is, how does your portfolio compare between the darkest days of COVID and now?
I would say in our portfolio, there's actually a lot of consistency, but that's because we went into COVID with a great portfolio from our perspective and from the perspective of which sectors do you want to be in to generate great performance. So when I think about Blackstone real estate over time, when the financial crisis hit, 50% of our portfolio roughly was in office, 50% in hospitality. And when we got to COVID instead, only 7% was in hospitality. And I think something in that sort of neighborhood was office, and a big portion of that was lab office and also studio and media content office, which is a great performance. So again, there's been a lot of consistency, and part of that is COVID and what happened during COVID really accelerated trends we were already investing behind, and so we really just took opportunities to do more of those.
How did you know that those, tell me, is there a metric out there? There's so much stuff coming at us right now. What are the metrics you follow to say, okay, this is where we have to start buying, investing now, because that's what's going to be big 5 years from now, 7 years, 10 years, whatever?
Well, our process, and it might sound funny for a real estate investor to say this, but our process really starts with what's happening in the world away from real estate. So what is happening in how people are living, working, spending their leisure time, and which are the assets that are going to benefit from that? So you think about the explosion of demand for content, and that was starting pre-COVID. COVID certainly has accelerated that. Or you think about the unprecedented data creation and consumption. We've created more data in the last 3 years than in the rest of human history combined. You're seeing that in demand for data centers. So what's happening in the world helps us identify, well, where are the sectors we want to be? And so a good example is we bought a company, we took private a company called QTS. It's a $10 billion company. We in real estate did it in partnership with our infrastructure business. And our scale was a huge benefit there, right? Because we could buy a great company with a great management team with the opportunity to continue to grow with their tenants. And we saw things, again, not that we thought data was peaking and demand was peaking, which maybe others would have thought given kind of the trajectory that business had been on. We said, actually, we think we might just be at the beginning, because just think again about what businesses are doing, what people are doing. Right. And what we've seen in our first year of ownership is actually more leasing activity than the company's entire 15-year history combined cumulatively. So we certainly, of course, have to always look at supply trends. Supply, is one of the things that works the hardest against you in real estate space. We care deeply about what is our basis and assets. But I think as far as developing themes, figuring out where to go, we try to think of where are the places we're going to have the greatest tailwinds.
All right. Having said that, so we've all read about a new Blackstone flagship global real estate fund, $30 billion, and that you've raised around $25 billion in just 3 months. The remaining is expected to, I think it's already fully allocated, expected to be the largest PE vehicle and drawdown fund in history, about 50% larger than your predecessor fund of $20 billion, which at that point, back in 2019, was the largest ever real estate fund at the time. Massive. Why now? How quickly do you expect to put that to work?
Well, I would say
Is that a sign of that there's lots of opportunity?
So I'd say a couple things. One is I'm limited in what I can say about fundraising. But two is I think it's a sign of two things. One is confidence from our investors, because we have been doing this and delivering great returns for a very long period of time. Investors are leaning into their best managers who they think have the most differentiated opportunity set. And yes, I think they and all of us say, we don't exactly know what the opportunities are going to be or how they're going to materialize. But we know Blackstone, with its scale, with its team, with its experience, and with this thematic approach, is really well positioned in any environment, and particularly now where there's a lot of dislocation and volatility.
We're going to leave it on that note. Kathleen, we could have talked for hours. Thank you so much. Kathleen McCarthy, everybody. Thank you, everybody.
Please welcome to the stage Bloomberg's America's leader for BQuant Sales and Development, Pierre Cox.
Hello, everyone. My name is Pierre Cox. I manage our BQuant solutions and sales team here in the Americas. I'm here today to talk to you a little bit about some of the tooling that folks here can use to perform some of the different analyses that we've sort of been talking about and really delve into some of the concepts that we want to dig into a little bit more. So basically, my team focuses on the sales portion, idea generation within sort of the BQuant enterprise ecosystem. And I'm going to tell you a little bit more about what BQuant is today. So when we think about the broader investment community, there's been a steady shift away from just fundamental, moving more towards a quantamental approach of looking at the world, which obviously involves more data. The move towards big data, potentially applying machine learning techniques to gather additional insights as to what's happening in the world. And when we think about this, we think about an end-to-end quantitative workflow. And we look at it here in about 5 distinct buckets. The idea of data acquisition and ingestion, validation of that data and that mapping or linking of data to different data sets that you might have, model development and signal generation, portfolio construction, and then finally actual deployment and strategy execution. Now, we can see from this slide here, and you might disagree with the details of the numbers themselves, but relatively speaking, we can see that there is a disproportionate amount of time and money associated with those first 2 categories, the actual data acquisition as well as the validation and mapping. Now, you could argue that the magic happens in these last 3 steps, but as we all know, garbage in and garbage out. So if you don't do the work necessary to make sure that your data is right, you might end up on the other end with conclusions that don't necessarily make a lot of sense. So why do we see such a disproportionate amount of time and cost going into these first 2 categories? Good data is hard to get. That's really the first one. The second idea is, do you have the internal expertise? Do you have the infrastructure to support big data, machine learning, back testing, factor analysis type workflows? There's a lot that goes into that. It's the people, human capital, the time, building out the infrastructure, and actually having the data at your disposal. Now, There are a lot of different tools out there, tools that help you automate certain processes, tools that might help you on the visualization front, allowing you to identify outliers in a data set, for example, something that shows you what type of influences certain factors might have on that data. But I suppose the real question that we need to ask ourselves is, what tools can we use that can help us limit or minimize those first two categories? We don't want to spend so much time going through this data process. We want to get to the end, we want to get to the results, and we actually want to get to some conclusions. So let's take a look at bQuant Enterprise. And as I said, bQuant Enterprise is an end-to-end cloud-based investment research platform that's built directly into the Bloomberg terminal. It's a Python-based integrated development environment built on a popular data science platform known as Jupyter that allows you to build custom applications in the terminal. Now, why exactly do we need something like this? Anybody who's familiar with the Bloomberg terminal knows that there are lots of functions within that Bloomberg terminal. These functions are great, and our product teams do a lot of hard work to make sure that these functions address all the needs of every person potentially sitting in this room using the terminal. The reality of the situation is that as good as we can make these functions, they aren't going to address 100% of what the people want to do. Somebody always wants some little nuance in their workflow, some different bent on an analysis, a different input to the actual data set. So that's where something like bQuant Enterprise comes into play, because you can fully leverage the data that we have within the terminal. You can ingest data from proprietary sources that you might have, your own internal database, for example, other relationships that you might have with other third-party vendors. If you're using something like Snowflake, another data lake or data warehouse service, for example, you can bring all that data in, blend and munge that data with Bloomberg data, and then to go ahead and drive closer to your actual conclusions. So this is a fully managed solution that we provide within our cloud environment, and we can get folks up and running within bQuant Enterprise within just a couple days to a couple weeks. This is particularly advantageous to those that don't have existing cloud infrastructure, those that are on a timeline to migrate a workflow from, let's say, an Excel spreadsheet to a quantitative or Python-based workflow, as an example. So those are some of the things that, that this brings to the table. And when we think about the idea of automating certain processes, systemization of something that is a manual process that perhaps your analyst team is doing, or even just the idea of scalability. Because you're operating in the cloud, you have the ability to scale up the horsepower necessary to accommodate the increasing complexities of the workflows that you might have out there. When you start attacking things such as big data, when you start thinking about how can we potentially use something within the machine learning space where you're not always sure what you're looking for. You know you're looking for something, but you don't really know what particular conclusion that you might be driving at. So that is meant to give you a quick Cliff Notes version. The full demo is obviously much more extensive, but that at least gives you an idea that you have this development environment that allows you to build applications in the terminal. The terminal acts as your primary application deployment mechanism within your organization. So bQuant Enterprise is basically offering you data, a deployment infrastructure in the terminal itself, and the ability to quickly ramp up into the cloud. So let's look at a practical example of an application of bQuant Enterprise that leverages a European Central Bank working paper looking at nowcasting the business cycle and trying to essentially determine, can we get an understanding of how shocks propagate through a network of securities or a universe. In this case, we're going to be using the S&P 500. So this is using a concept called Granger causal relationships. And what it essentially does, it's going to go through all of the members of the S&P 500. You can see in the bottom section where we talk about these challenges that we reference 124,750 pairs. For anybody that remembers their statistics, combinations, and permutations, essentially what we're talking about here is what are all the possible pairs that we can make within the S&P 500. We push all that into the algorithm. We make a determination as to what relationships exist between these various pairs of stock returns within the S&P 500, run it against about 30 years of history to really get a sense of which of these securities might have more of an effect on the stock returns of other securities. Essentially what we're doing is we're evaluating contagion, is a good way to think about it. So what are some of the challenges with implementing something like this? Well, first of all, it's just the sheer quantity of data. You're talking about a lot of data that you need to pull into this type of algorithm. The various pairs of tickers, the full sort of history of time that we're applying this analysis to, and then the overall time to compute. Now, this might vary depending on what type of machine you're operating on, but could get up to 100 hours of actual compute time, which isn't practical if you're looking to get quicker answers in some cases. You can't always wait a week. So how does bQuant Enterprise help to solve this challenge? The first part is just with the data. bQuant Enterprise leverages a proprietary query language algorithm known as BQL. Many of you are already probably familiar with BQL. You might remember the old legacy API of BDP, BDH, and BDS. BQL is sort of the new version. Think sort of Bloomberg's proprietary SQL. I think that's the best way to think about it. That's plugged directly into bQuant Enterprise, allowing you to query our databases directly from the Python environment and pull that data in seamlessly. We also provide data in Parquet files on S3 buckets that sit within our broader environment, giving you access to things such as some of the alternative data sources that we have within our ecosystem as well. So when we think about where to get this data from, it's an incredibly difficult task to stitch data sets from lots of different vendors together and have them actually make sense. Bloomberg provides that data for you pre-cleaned, ready to go, point in time, everything that you need. So that really cuts into that, those 5 steps that we were talking about before, especially those disproportionate steps at the beginning of the process. The second part of it is the actual compute. The sheer quantity of comparisons that you have to make and that time period, 30 years of time, almost 125,000 different pairs that can be made within the S&P 500. You need to do something to reduce the amount of time. We can do that with distributed compute, utilizing tools such as Spark, parallel computing as well, to really cut down on the sheer quantity of time that we need to run this type of process. And basically what this graphic here is, and it looks kind of like the sun when I'm looking at it now, but the general idea is these are all the different nodes, and the ones that are pulled to the middle are the ones that have outsized influence on the other securities within this broader ecosystem. That's essentially the visualization that you're seeing here. And then the last part of it is just pushing out the results. Now, in this case, we're basically determining recession or not recession with this particular analysis. So there's not anything too fancy here with the actual visualizations themselves. But the bQuant Enterprise environment provides you with all the necessary tools that are available to regular Python programmers that are out there in general. And then we also have a couple of proprietary libraries that allow you to build quick visualizations in a couple of lines of code. So it really kind of allows you to take in some data that's already available for you. We've got tons of libraries and support that allow you to munge that data. My team has built lots of different examples within the ML space, looking at things such as collaborative filtering, natural language processing, that really allows you to get to the meat of what it is that you're trying to find out. So on this last slide, I decided to put a nice, pretty application up. The other one had a very interesting analysis with kind of a blah output, but this is one that really sort of flexes the muscles of sort of the visualization capabilities and the interactive items within the platform. This is essentially looking at estimated spread changes of corporate and government bonds within a specific universe, and then tries to get a sense of which factors or features have the most influence on how these spreads behave. And then on the right-hand side, you can kind of see this 3D graph that gives you a sense of where the outliers might be on your portfolio versus the broader universe or the broader benchmark. So this being said, I think when we think about applications like this, we could take that nowcasting app and kick off the S&P 500 or get rid of the S&P 500 and maybe even apply it to something like MSCI World with just a couple of changes to the code that's available there. So essentially what I'm trying to get at and to get everyone here to see is that bQuant Enterprise is a tool that's going to allow you to really dig into the details of your analysis a little bit more. It's going to make what you're doing more efficient, Hopefully it'll make it faster, it'll give you the access to the data you need, and provide you with tools to really create a dynamic and interactive way for analysts or quants or portfolio managers to really dig into the minutiae and get a sense of what's happening within their world. And I think that's particularly important with, as I said before, when you're doing some of these machine learning techniques, it's not always clear exactly what you're looking for. You just know that you're looking for something. So I'll conclude with that. Thank you very much for your time, and enjoy the rest of the session.
Please welcome to the stage IronNet founder, chairman, and CEO, General Keith Alexander, with Bloomberg's Katrina Manson.
Well, thank you, everyone, and great to be here at this critical time. Can't wait to hear what you've got to tell us. General Alexander, let me start with a really key question. Does the US have the capability to prevent Russia from launching a nuclear attack through any kind of cyber means?
Great question. I can't answer that, obviously, but it's a great question. I would say that that has so many facets to how you could stop an attack and what you do, that it would be reasonable to assume that the government looks at all options, not just cyber, to do that, and across its portfolio, to look at every aspect of a launch and the precision that goes with it and stuff. So I would expect, I have no inside knowledge, I've been out for 8 years plus, but that's what you would want our government to do. You want our allies to do, is how do you stop something like that? How do you shoot it down if one were to occur? That question has a second part. What about in Ukraine, a tactical nuclear weapon? That would be more difficult, right? Because that's something that's going to go very quickly. So the key would be trying to understand, did they deploy nuclear weapons to the theater? That's got to be an intel, not a cyber, an intel function. Try to get out in front of that. So it's both parts. So yours is on the strategic. I'd expect all nations would work on that. On the tactical, much more difficult.
What's the lead time for knowing if anything is being deployed in terms of an intelligence operation?
Well, it depends again. So, it's not something you just pull out of the garage whip up and fire it off. So I suspect that they would deploy and have the trained units and stuff there if they were going to do it. And those indications would probably be picked up by foreign intel, ours, Europe, and others. I think they would actually do that. And I suspect that our government and other governments would be messaging Putin on just that, as the president has already done. I think those are the right things to talk about what that impact would be on this war and what our nation, Europe, and NATO would be willing to do in the next step after that. So really tough, Putin's in a tough place. By asking that question, his back is up against the wall. He thought he would take over Ukraine. He thought this would be 72 hours. They're going to fall on their back. And the Ukrainian president and their military and the Ukrainian people changed all that. They are the real freedom fighters of our generation. They're fighting for their lives.
And it's obviously a very tense situation now. You've previously said that the use of tactical nuclear weapons in this conflict you thought was unlikely. Is that still your assessment?
I still believe it's unlikely. I believe he's considering it. He's for sure considering it, and there are options that he could look at, testing and other things. I think if he uses a tactical nuclear weapon, that's the end of his regime. I think countries would now start to move in a much more aggressive way, and it would be right to do so. So I think what he's trying to figure out is how does he get out of this corner that he's in? And everything he tries to do, he's being pushed back on. I just want the 4 regions of eastern Ukraine. Oh, the Ukrainians are fighting back and having great success against them. So he's losing, and that means in Russia, the media, your counterparts, the intelligence community, and the military are starting to lose faith in him. And by losing faith, those are the three elements of power that he needs to stay in power. So the massive set of launches, missile launches over the last few days against Ukraine were meant to show that he's still in power and he's still firm, but they didn't get what he really needs. I think it's on a downward trend for him. And so what does he do? That's where the nuclear weapon question comes in.
Do you really think he's under pressure in his leadership? And how do those cracks develop and show and expand? Up until now, there really haven't.
Well, actually, there has been a lot. So if you look at the military bloggers in Russia, and there's a whole bunch of them, they criticized that Russia was doing a half step in the war. They weren't applying the full force. Where's the full mobilization? Get the Russian army out. Make this fight. And remember, he looked at Gorbachev and what he did in Afghanistan as a huge failure. It caused the collapse of the Soviet Union because they fought in Afghanistan, but they pulled people out of Moscow and out of St. Petersburg. Think of all the major cities, and the Russian people turned against him, turned against Gorbachev. So he didn't want to do that in Ukraine. So when he's recruiting people, this army that he's building, it's from the minority groups. But it's not the training, the time, and all that's insufficient. So the military bloggers, I think one of the things, especially with your background and insights, I would track what are the military bloggers saying about the war. These are key people that in the past have been pro-Putin that question it. Same with the intelligence community, and the same with the media. And you are seeing cracks in all of those. So I think that for him is of great concern. What he'll do is he'll push back, arrest key individuals in those things to get a check and try to stop that. I think it's too little too late on both the conscription. Those people won't be ready to fight for a long time. And I think the military bloggers, the military, the intelligence community, and the media will see this as we're losing this war. Why are we here? And we've alienated the rest of the people, and it's killing our economy. And if they don't fully mobilize, they'll never be able to beat Ukraine.
Do you see a pressure point developing to such a point that he, how does his future look in the scenario that you're painting?
Bad. I think the future in all of those looks bad for him. Now, this is where a military dictator like him, what he's going to do is he's going to try to suppress the people and stay in power. At some point, I think people are going to start to move against him. I really do. I think that's going to get to the point where the Russian people and some of these the military intel community are going to move against him. He's going to try to stop that, and that's the fractures within Russia that we'll see. What can he do in Ukraine as a half step to get there? I don't see the Russian military able to have an effective counterattack. They can do local, but their forces, the morale is low. They're losing faith. Many of them didn't want, initially they thought this was a peacekeeping thing. And now they're seeing all the people that are being killed and wounded. So he's in a difficult place. He really is.
On the spectrum of apply more pressure, provide exit ramps, can you talk about how that balance needs to work? You've previously argued for more pressure. You've argued for a no-fly zone, which is not, of course, what the US government is doing, to take back the initiative. There's actually been criticism, of course, of the administration for and others for not doing more to provide exit ramps. How do you see that spectrum?
For him to exit, I think if he exits where he is today, it's a failure, and that would lead to his downfall. He's got to exit with some kind of win or some way of showing a win, or blame somebody and make that stick as if it wasn't him, like Shoigu, the Minister of Defense. So I'd say the Minister of Defense, he's on the first chair, and next to him is Putin. I don't think Shogu will be good enough for the Russian people if they withdraw. With respect to the no-fly zone, I do think putting pressure, how do you defend the Ukrainian people? What is it, our responsibility, without getting into a war with Russia? That could be a greater war, that could be a real disaster. And so we have to look at all the different things. I can start with the no-fly zone. And I think the half step is, well, how about we put in an air defense system and network to shoot down missiles and aircraft and provide the Ukrainians that. It doesn't mean U.S. forces and others are applying the no-fly zone because Ukraine doesn't have the Air Force to do it. That's probably a better half step right now. I think that's probably the right choice, and you can see all the countries kind of agree because they're moving the air defense platforms in. I think that's exactly right. What does that say to Putin? You did A, now we're going to do all this. And the other part that came up in those missiles that's really telling is those missiles, the precision-guided missiles that they have require technology, which they don't have access to because of all of the sanctions. And so now they're shooting dumb missiles, and those don't have the accuracy to get what they need, and he's got to save his precision for other events on the tactical side, force on force.
In reining in your vision for a no-fly zone, what does that mean? Does that mean that really you think a no-fly zone would create a direct conflict between the US and Russia? Or have you always advocated it as a means of stepping up but never actually getting as far as you
I think
suggested?
it's absolutely something that should be considered. The question is, how do you do it? If you're going to do a no-fly zone and not have our forces involved, that means you've got to give them the aircraft, you've got to give them the training, and you've got to help them on that. That potentially was a red line that our government was not willing. And so they have access to classified information, which we don't have. I suspect that they're doing this steps very deliberately to not get into a war with Russia. And, my personal belief is Russia does not have the military to fight NATO, period. You could see that. They can't fight Ukraine, let alone NATO. And NATO has no desire to go into Russia. So I think he makes that up to get the Russian people behind him. But eventually the people are going to understand that's not true. So
let's come to your particular expertise in cyber. In February, before the invasion, you said that if there were an invasion, it could lead to the first full-scale cyber war. Now, as you know, there have been many analysts who've said that hasn't happened. What's your assessment of what we've seen?
So there's two parts to that. First, in Ukraine, there has been a huge increase in cyber activities, destructive cyber attacks. As I told you, I had an opportunity to speak to their Minister of Digitalization this morning, and his comment was the attacks have been significant, and they see future ones coming that could be more destructive, and they're worried about that, and they're working on it. And it's not just going to hit them, it could hit Europe and the United States. So he was really concerned about that. At the same time, we defend forward as a nation. I think that's something that's out in the press that General Nakasone talks about. How do you defend forward and stop somebody from attacking you? I think that's been very successful, not only in helping on the elections, but in this place too. And I suspect it's not just our country, but our allies are doing the same thing. So that's difficult for them to do all of this. Their primary objective was Ukraine, and I think they focused on that. But you hit on a key point here, because cyber, he wants to win in Ukraine. He's not going to win in Ukraine. He's not doing it. What can he do to get the American people and the European people to back off of support for Ukraine and make the pain here so much that we say it's not worth it to us? And that could be through attacks on critical infrastructure and other things that, think of, the Colonial Pipeline times 10 here and in Europe.
What is the Colonial Pipeline times 10 in America?
Well, the Colonial Pipeline, if you recall, just in 1 week of that being down, there were gas lines that people were getting concerned. You could see what do we do? We're running out of gas. That could be a huge impact if you did the Colonial Pipeline, multiplied it in 10 areas, and or do other critical infrastructure that impacts us or the European Union. So those are, I think, clearly under consideration by Russia. This is something they would look at.
I suppose the point is, from the US perspective, is those attacks on critical infrastructure in the US haven't happened yet. Why not? And why do you think he would make that decision to start?
Yeah, so the reason, my opinion, is right now, up to this point, it's been focused on the Ukrainian military and the Ukrainian government to win in Ukraine. His forces are hammering the Ukrainian government, military, and critical infrastructure. And a lot of companies are helping to build them back. And I think that, the Europe and the United States helping on that has been very useful for Ukraine, but they are getting attacked. Make no mistake there. So that's been his focus, to win in Ukraine. He's not going to win in Ukraine, and he's starting to see that. And the reason he's not going to win in Ukraine is because the United States and Europe are behind him providing weapons. So the question is, how do you get them to stop? How do you get us to stop support? And I think he's going to say, well, we're going to give them some of the pain to do that, and it would be in cyber. If it's any other military action, it defeats what he's trying to do. He wants us to withdraw support so he can have those 4 regions and claim victory. And so that's going to be the diplomatic, military, strategic fight right now.
But the Biden administration has been so clear that it will respond heavily to any Russian attack on US critical infrastructure. Why would he take that risk?
Well, when you're cornered and you have no other alternatives, a nuclear weapon would be, I think, a step too far. So what can you do that we really don't have the strategic infrastructure thought process on? This is a cyber attack. What do you do? And if Putin says, well, it wasn't me, it was these hackers. So what he's going to do is look to the hackers and use them as I think, the folks that go after it.
Does plausible deniability work anymore in this context?
Well, it doesn't have to work 100%. He can say it wasn't us. We can say we know it's you. He can say it wasn't us, and you can see how that's going to go. And so then the question is, now you get the more clandestine war going, and I think that's where it would pick up. And I just, as I look at all the options he's got on the table, and you do a strategic analysis of all of that, you'd say, if I use the nuclear weapon, I'm out. What can I do to make those guys stop providing weapons and helping Ukraine stay in? So it's got to be something in that area.
But given the US has said they'll hold Russia accountable for even proxies, does that mean that the US still doesn't have strong enough responses on this front?
I think it's a different question. When you look at that, it's not just in Russia that these guys could come from, but it's a global attack. And seeing those attack on critical infrastructure is very difficult. And so that's the hard part. When you think about, despite what everybody says, the US government is not looking at everybody's network and watching them. And so the fact that they hit a critical infrastructure, whether it's energy, oil and gas, defense industrial base, transportation, you hit one of those, the chances that the government will see it ahead of time is very slim. And so you lose that. Now you can go after them, but you've already lost. It's like there's a missile hitting a city. We don't know until the city's been hit, and they call us up and we just got hit with a missile.
For all the investors in the audience watching, of course, the US has warned before about Russian malware being on critical infrastructure. That, of course, includes financial services. To what extent do you think Russia has malware on the systems now, new malware that the US has yet to discover today?
Well, I would say almost for sure on some. I think my assessment of the big companies do really good in protecting their infrastructure. So I think it's going to be in some. I think they're going to have success in some. And there are parts of our infrastructure that are very difficult to hit or to defend. So you're seeing states hit, right? State infrastructure, you're seeing airports be hit, all these things that provide that. That's going on now. And the question that I think we should ask is that the prelude, is that tests for a future? And the answer, I would say we have to consider it, that it is a test. They are practicing for something, and we need to be ready for it.
You've talked before about a 9/11 in terms of cyber threat. Do you still hold on to that idea? The sort of the cyber Pearl Harbor idea has sort of gone out a little of fashion. Are you still holding on to it?
I do think that, knowing what the offense can do concerns me that our defense is not ready. And it's not just our offense, it's others as well. Now you push cyber into an act of war when you do that. And the issue is proving it and convincing the United Nations that you have the proof to do that. So that's going to be the issue that's played out on this.
You mentioned cyber defense is not being adequate. Obviously, the Biden administration has taken many people from your old agency and put them at the top of different elements. Government Accountability Office saying there still isn't enough coordination. Even there's another report from them out saying nuclear contractors are inconsistent in the way they look at their own cyber practices. Why is it still so far coming from behind?
Well, great question, because this shows what you're hitting on is the real issue that we have to look at in cyber. Today, every company defends itself. Every agency defends itself. Think of that as every city had to defend itself. We'd lose. And yet, that's what we're doing in cyber today. We share what we know once we know it, but there is no way to create a cyber radar for collective defense. That's what we have to do. That's hard because you have to train people, you have to deploy capabilities to do that. But I think that's the future of cyber. It's just a question of what forces us to make that move. It's like building that radar system that you'll put into Ukraine to defend from the missile and air attacks, to now say, how do you do something like that across the country, our country, and our allies to defend against cyber? That's where we've got to get to. And I think the hard part is the SOC analysts, those analysts that are actually down in the trenches working it. Right now, they're defending by themselves, doing the best they can. But if everybody defends by themselves, we have a historical thing. If we fight alone, we're going to die alone. That's why we have to fight together. The 13 states, that's one of the mottos. I wasn't there, no.
You've talked about joint security operations, suggesting private sector companies can come together and actually take action, not just defend, but take action. Is that really on the cards? I don't know how much.
So I'm not an advocate for commercial companies taking offensive action. I think what commercial companies can do, just as we do for cities and our radar, they'd say it's coming from there, and the federal government has a responsibility to defend. And that's what we've got to practice. We've got to practice that just as you would any other element of warfare. And it's by training all those analysts in all these different companies how to work together, how to share information, how to do that. I think that's part of the future. Because this area is going to break wide open. And, unfortunately, we don't know where and how, but I am concerned about that.
We were given special dispensation to have a little 5 minutes extra, so I'm going to definitely take that since we have you. In the case of Iran, how vulnerable is Iran to a potential Stuxnet-style attack, if ever it were on the cards again?
I think Iran, there's a couple things with Iran. First, as you look at it, Iran is breaking apart right now with all the riots and stuff that are going on. The supreme leader, I think, is not healthy. I think the potential leader coming in, Ibrahim Raisi, is even more conservative. He was on the committee that judged all those people in 1988 and sentenced them to death, tens of thousands. This is a really bad place. With respect to the question, so how do you stop Iran from making a race to a nuclear weapon? That's the question. And what do you do to prevent that from happening? That's what the administration has got to weigh. Is there some capability out there that they can use? I don't know the answer to that. Again, I've been out for 8.5 years, but I would suspect you look at all elements. Here's the concern I have, is that if Iran does make a race to a nuclear weapon, we have to be concerned that Israel is going to react in its nation's interest and try to stop it. And that's the problem you create in the Middle East. And so this is the issue that you have. Well, how do you keep Iran from making a race to a weapon which they said they would use on Israel, and keep the Israelis knowledgeable that they're not making that race? That's the issue.
I see you're saying there are various things that anyone could, in the US, might think about, but do you think cyber, after the Stuxnet attack, is a potential plausible avenue now, as the JCPOA effort to get it back on track looks like it's not going to work out?
I think cyber is one of the elements that they would look at across the board. You would look at all of those, and it's logical that you would do that.
We're obviously in an investor crowd. You've got your own company now, which you started in 2014. You took it public via a SPAC last year, and you're in a difficult position today. Your share price has gone from $41, I think, last year. It's at 52 cents today. I think that's an all-time low. You took a pay cut this week. You've volunteered to go down to, I think, $50,000 a year from $360 baseline that you were at before. Lost a lot of staff. You were a co-CEO. You're a CEO on your own now. Tell us what that experience is like for you.
Well, I think clearly it's tough when you have to reduce force with people that you've worked with. But as a public company, it's our responsibility to make this company viable on sound financial foundation, and continuing to push the product and to have a company that will be really good in the future. So we have to look for the future. It's interesting, we're not the only ones cutting, and we're not the only ones losing value. But you hit the key point. That's of concern. We have to build that back. We have to go back to the street on the financial and all the issues that we promised them, and we will do that. And we have to show that what we're talking about here is collective defense. That's what our company does. Nobody else builds the tools SOC analysts need to defend together. We need to do that.
Is there a problem with the product or faith in the product?
I think the problem that we have is we've got to train SOC analysts to use it. It's a more advanced system than you would normally get. So if you have an advanced SOC operator or you train them to that, they find it very useful. So you have people that really like it. And then if you bring in a junior analyst and it's difficult for them to use it, they want to just be told what to do. We've got to train SOC analysts to take that next step and work with them, and we're doing that. The other part, I think the more accurate part for us is that we try to start here with companies. And so what we realized is that, well, we have this technology we should share on threats that we see, on command and control for infrastructure. And so we created a new product and sent that out and announced that on September 29th, called Iron Radar. And the intent was, what if we could see future command and control by countries like Russia and others before they use it, and provide that to people? How valuable would that be? And everybody said, wow, that would be great. So we're going to take that half step to help us get more market share and then move up. We're going to still push this collective defense. That's the key to the future. And we are getting traction. We just got to get that going.
The last thing, of course, is you're facing a class action complaint. That's from some investors who say that at the beginning, when you went public, that they're calling it fraud. They're saying that you sold shares once the share price was high, $5.1 million worth in a short amount of time. That was 85% of the available shares that you're allowed to sell in that time. I don't think you've submitted the legal response to that yet. I'm sure it's coming, but can you let us know how you respond to that claim?
Yeah. So we actually did respond to that in our 10Q. And we thought that the lawsuit was without merit and that we'd defend it vigorously. And so we put that on the table. And the article you hit on claimed that I sold 85%. You know that's not true because you said it exactly right. I still own 96% of my shares. I'm in this company because I think it's the right thing to do for our country. And I believe we need something like this. And so we're going to figure out a way to make it work. And that's what we got to do. And, no one likes to be where we are. Well, you look at the whole tech industry. Nobody wants to be where the tech industry is today. But the reality is we can see where this product will go and what we'll do in the future. And we've got a great team of people that really understand the value. So I think a lot of work to do. Make no, I won't, try to push that aside. There's a lot of work that we need to do to get there. I think we can do it.
Well, thank you very much for all of you for sticking with me, talking investment, Russia, a little bit on Iran as well, and here we go.
Thank you.
I'll let you get back to it.
What a great way to wrap up. We hope you all enjoyed the last couple of days. That is a wrap for Bloomberg Invest. So great to have everybody back in person post-COVID. Did you all enjoy yourself? Yeah. Learned a lot? Well, we do thank you. And we also want to just remind you to continue engaging, #BloombergInvest. We love the input that you guys give us throughout the conference, but continue it on social. We do also want to thank our speakers, our moderators, and also all of our sponsors. Our U.S. presenting sponsors, Crypto.com, Grayscale, Invesco QQQ, and our presenting sponsor, VinFast, who all make it possible. If you want to know anything more about the sponsors, you can go to the Resources tab on the event website, the Bloomberg Live. We have lunch, networking for you, so right after we're done, please make your way to that if you'd like to. And if you missed anything, you can go to BloombergLive.com, Bloomberg Invest to view on demand, which is a great way to try to go through all of the conversations over the last couple of days. Yes, indeed, we have a bunch of upcoming events in the fall. October 18th in London for the Bloomberg Equality Summit, one of our really popular and smart verticals here. On October 25th in New York, Bloomberg Chief Future Officer briefing. We do a lot with the chief financial officers in terms of their importance in strategy for companies. And then November 3rd, we have the Bloomberg Growth Summit. So really looking at growth opportunities. And sometimes it's the smaller, mid-sized players that are really significant in that space. That's November 3rd. We do it in person. If you can't join, you can definitely join us virtually. So you can go to BloombergLive.com to sign up and find out all the details. Thank you. So great to see faces back here at Bloomberg headquarters. So don't forget lunch and networking. Take care, everybody.